Let's start with the second part of capital gains. So, we are going to discuss the chapter called Other Sources. When income doesn't fit in any category, that is, not salary, not business, and not property, then that income is classified as other. So, Section 56 of Income Tax Act 1961, it talks about the income which is received from other source. It covers income which is not a pension, income which is not a salary, income which is not from house property, income which is not a capital gain. So, what are the incomes which are not salary, pension, property, or gains or income from business or capital gain? They are classified as Section 56 other incomes. So, let's discuss more in detail. There are 10 types of incomes which are pooled. The first one is investment income. Here, dividend from domestic and foreign companies is included. Second, interest on securities, bonds, and debentures, and income from mutual fund. So the first part is investment income, where I invest something and I'm getting periodic or lump sum returns that again classified as income from other source. The first part is investment. So investment in debentures, securities, or bonds from India or from foreign companies, as well as income from mutual fund is considered as other income. The second is windfall gain. Now, the name windfall means if it is generated or it happens or it is just a result of certain act. So it is called as a windfall gain. So because of happening of certain event or occasion, the things are such a way that it results into income. The best example you can remember is a lottery, a gift, or a prize. Now, lottery, gift, or prize, these are not certain my regular flow of income. This happens to be a situational base, or this happens to be a purpose base. I play the game, but not necessary that will give me any gains. I may win, I may not win. So, earning a prize, getting a gift is not a regular routine. For this, I need to perform, and my performance should be excellent for that situation compared to the others. So that is a windfall gains. So the second income, which is fall under other income, is lottery, winning game shows, then gifts and prize or awards. Now please remember, gift up to 50,000 is not considered here. It is allowed as exemption. So a gift received below 50,000, it is allowed as exempted income. Then there are some other miscellaneous heads which are pulled it under section 56. So what are that heads? First, rental income from machinery or furniture. Second, finance insurance proceeds. And last, compensation of employment on termination. Now, the rent received from machinery or furniture. It means I'm not giving let out a particular plant, but only a machine is given on rent or a furniture is given on rent. So in under other heads, I cannot calculate their income because if only one machinery is given, then that machinery cannot be accounted for the same. I need to understand the machinery has to be given with different plants. So as per section 56, only one machinery or a furniture, if suppose whole plant is there, one, two, three, or different machinery where input is there and output is created. So this will be accounted as income from business and profession. But since I'm just I'm just doing the rent of business, that is machinery or furniture, then this income is also called as income from other source. When Keyman insurance proceeds, it means if any person dies or any accident happens, he receives income. Now, the basis of section 56 is it is surprise. It is a lottery, it is a gift, it is a prize, it is a compensation, it is a dividend, it is a interest or income. Whatever the things are there, they are not planned. Occurrence of these events depends on happening of certain activity or happenings of certain things. So, Keyman's insurance proceeds can be life insurance or can be non-life insurance. Keyman's means the person who is earning bread and butter. If he meet with the accidents, then his dependents can sue or claim from insurance the benefit for their survival. And that's why it's recognized as key man. Here, it can be key man or it can be key woman, depend on situation. Now let's move further. Lottery, crossword, or any puzzle, or any card game, or any other type of games, they are charged at 30% for gross amount which are your winning. So the games, the lotteries, and all the puzzles which you earn as per section 56, you are fully charged at 30% rate. Now let's take an example. In case Mr. Joshi, in case of Mr. Joshi, he received gift of 60,000 from college friend. Now up to in gift 50,000, it is exempted. He has received the gift of 60,000, so more than 50,000 limit. So the entire amount is taxable as income from other sources. Then, if Mr. X or Mr. Joshi in this case, he wins 1 lakh prize money, then this prize money again taxed at 30%. Because whatever the surprise income or what is unexpected gains, they are accounted as income from other source and they are taxed at 30%. Now, when you receive this type of income, it is classified under Section 56 as income from other source. And Section 57 talks about what are the deductions available for C. Till now, any doubt about what is meant by income from other source? If any doubt, please ask me in chat box. Okay, let's move on discussions about deductions, since no doubts about meaning and the concept. For getting this income, if I have spent some amount or I need to spend some expenses, then all such expenses which I pay or incur directly or indirectly, For realizing gain into income part, I am liable to get deduction for such charges. It may be tax, it may be bank charges, it may be any other charges, or it may be convenience charges, or it may be that particular state government charges. They are allowed as deductions. Second, in case of family pension, if my pension is as low as 15,000, then it is fully exempted. Or if it is more than 15,000, then one third of pension amount is allowed as exempted, and two-third can be taxed as regular salary. The reason behind one third is understood as one third is necessity, two-third is better living, and full pension is considered as more than required. Now, there is no logical base why one third, but it is assumed when the provisions of Section 57 were made, and that's why till we follow. In case of any asset repairs, insurance, and depreciation of machinery and furniture is done, and I'm giving that machinery and furniture for rent, and they are generating my income, then the expenses for repairs and depreciation and insurance is deducted from gain from that machinery and furniture before calculating final income or gain. Similarly, 50% deduction on interest components of assets buy or sale is also allowed as exemption. So if I want to revise, expenses for getting income are deducted, repairs and maintenance they are deducted, interest on components of compensation is deducted, and one third of pension or 50,000, whichever is lower, it is allowed as deduction from total of income from other source as per Income Tax Act 1961, Section 57. I'll wait for 2 minutes. Please read this slide again. If you doubt, you can ask me in chat box, or I'll move further after 2 minutes. Okay, so no doubts, I assume, and I'll proceed further. In case of income from other source, deductions is responsibility of person who is filing the claim. Similarly, if the income received is income from other source or income from salary or capital gain or business and profession, it is liability of the person who is filing return to give the work to the income tax authority. If the person fails to give the proof, then it will be at judiciary powers of income tax authority to decide whether it's a regular income or it's income from other source. The onus is on taxpayer. Onus means responsibility, or it is rule that taxpayer has to prove that it is income or expenses, whether regular or from other source, and also claiming the deduction, it will be responsibility of taxpayer. Income tax department will not accept any responsibility about the same. Now, let's talk about deductions available under Section 57 for dividend or interest on security. I can claim deduction of commission or remuneration of agent or middleman or his fees of documentation. For dividends on borrowed funds, interest up to 20% maximum is allowed as dividend. If I have given a property on rent or machinery on rent or furniture on rent, then whatever the repairs, insurance and depreciation, these charges are allowed as deduction. Family pension, 15,000 or one third of actual pension, whichever is lower, it is allowed as deduction. Interest on compensation, 50% of interest received on compensation for when I received the compensation when I'm leaving the job, then that will be allowed as exemption up to 50% of interest. So anybody any doubt, please ask me or just post in chat box. Let's continue further. It's very interesting heading. Deduction you cannot claim. So as per section 58, if I make a false claims or purposefully prohibits and claims deduction under false representation of my documents or false justification, I'm liable to pay the penalties for same. Then 56 section talks about income from other source. 57 section talks about what are deductions, and section 58 it talks about if I'm wrong person or wrongfully I claim deductions, then what are the limits or what are the protections. The first, no deduction is allowed for personal expenses. It should be professional. For example, for filing a return, I need to go from Pune to, from Vadgaon to Katras. Then the transport of Vadgaon to Katras is considered as personal. In this case, the deduction for transport is not allowed. Similarly, wealth tax paid cannot be claimed as deduction because wealth tax it is paid as income which is charged as my wealth and I'm paying it as tax. So its reimbursement is not allowed. Similarly, if interest is paid outside of India and TDS is not deducted, then that TDS which is paid outside India will not be allowed as deduction. Similarly, any expenditure incurred to earn in tax-free or tax-exempted part, that is special economic zones or tax concessional zones, in such case, I will not be getting any deduction benefits under Section 57. So I just revise it again. Personal expenses, well tax paid, interest earned outside India, income exempted from its source, these all are not allowed as deductions. So as per section 58, they are allowed as not allowed exemptions. So wholly or exclusively, the crucial test is qualification of deduction and justification of its purpose. So what is the first thing? I should avoid dual purpose quotes. If income is also quote as personal income and business income in same time, then these incomes are considered as dual effect. No concessions are allowed for them. If any concession given is resulting into generation of income or it is source of income, then it is not allowed. Whereas if documentation is not proper, it is questionable, and I cannot correlate the justification and documentation. In that case, the deductions which are allowed under Section 57 and discussion as per 58 are not allowed the deductions. Take the example which I given. Ramesh claimed interest expenses for monitoring his own investment. Now, if I'm investing somewhere, it is my personal decision where to invest, how to invest, and why to invest. If I'm investing and I claim that out of my investment of 5 lakh, 1 lakh is the monitoring expenses. Since it falls into personal, the income tax authorities or income tax laws does not permit such expenses to be considered for exemptions because here dual effect is breach and it is more personal rather than business. So let's wait for 2 minutes and just let me know if any doubt. I'll wait for 2 minutes. If doubt, you can also put doubt in chat box. Okay, no doubts. So let's move further. Section 94, it talk about anti-bond washing. It means securities transfer before interest payments or if transfer appears motivated by tax avoidance and original owner reassure the securities, then deductions are not given. Suppose I want to file a return and I find out clubbing of income will give more tax liability. So what I do before income tax payment, I transfer the asset to one of my friend, relatives, or family member, and claim that the income from that asset or security is on his name. And if his total income is under deductible limit, I claim deduction for him, then it is not allowed. So, for income tax purpose, if it is transferred or by tax avoidance, I do it, or it requires securities after interest dates. So, considering interest date and the reason, the anti-bond washing rule applies. And as per this rule, if these acts work to avoid the tax, they they are strictly fully chargeable to income tax. Section 94, subsection 1, ensure that income from securities means taxable in the hands of the person who had received it. If I transfer from my hands to the other person, then the liability will be judged based on user and beneficiary of that particular income. Now, in case of dividend stripping, it means payment of dividend. What happens? Investor buy shares before the declaration of dividend date. Once the cutoff date for declaration of dividend is given, and if after cutoff date I buy the shares or before cutoff date I buy the shares, it will make an impact. Normally, people who earn the dividend, they buy the shares before cutoff dates. Once I buy the cutoff dates and I receive dividend, then I sell the shares after getting benefit of dividend. In such case, this will be called stripping of dividend. Stripping means just taking benefit out of dividend and manipulating the rates in such a way that it will not impact as purchase, sale, or capital asset, but mere difference between the values will be recognized as dividend gain. In this case, if I'm registering my gain and I'm bypassing the interest or dividend earned, then it is again fully taxable up to the limit which I'm able to claim as deduction in regular fees. Now let's talk about the mutual fund dividend stripping. High net worth investors identify the mutual funds and they follow their declaration of dividends. For example, there are three type of dividends, sorry, schemes. One divide give the dividend on 1st March, other gives on 15th March, and third gives on suppose 15th April. Then what investors do? They will plan in a such a way that before dividend they will buy the assets, and once dividends are declared, then they will sell the assets. Because if I'm selling the assets with dividend, I'm getting higher gains. But while calculating tax liability, my gains will be adjusted against dividend received. So this is called a dividend stripping. Stripping means जसं आपण केळी साल सोलतो तसं आपण त्यातनं डिव्हिडंड काढून घेणार आणि केळी साल तसंच परत विकणार. So here people take out the dividend benefit and resell the asset as it is for its original price. So I'm just taking out the dividend received, and that's why it is called as stripping. The next, as per section 94, if any dividend stripping is done, then this dividend stripping is strictly liable for tax liability. Proof that it is not dividend stripping but incidental or it is pre-planned is liable on the person who is filing return or involved in such act. Income tax authorities will give two hearings, and beyond that, then he has to appeal for the tribunal in case of dividend stripping. Here again, the responsibility for disclosure and claiming is on the person who is filing income tax return. Section 94 represents the tax department sophisticated approach for advanced tax planning. As per this, if I have certain analyze the source of income as dividend, interest, or bonds, then I should plan such a way that whatever the taxation liability, it should be minimized. And I have many legislative tools to counteract them so that on earnings I don't require to pay any taxes. So to just revise the income from other source in capital gain, Section 56 defines what is the income which is not part of any other heading. That is, it's not part of salary, business and profession, income from house property, and it is not part of any other. So it defines what is income under other source. Section 57, it talks about the different deductions. Normally, deductions are applicable up to the expenses made 15,000 or one third of pension, repairs and depreciation for furniture and machinery and other liable assets. Whereas Section 58 talks about prohibitions that when the benefit of deduction is given or not given. And Section 94 of Income Tax Act 1961, it talks about avoidance of schemes. So this is what all about income from other source. I will wait for 2 minutes. If any doubt, please ask me in chat box. So I guess there is no doubt. So we'll move forward. This was all about income from other source. Now further, let us study section 56, 57, 58 in other dimensions. We talk about section 56, 57, 58, and 94. 56 defines the income. 57 talks about estimation and deductions. 58 talks about what is not allowed. And 94 talks about how much and why it is allowed or not allowed. So basically, these three are interrelated. Now, let's go more details about section 56. It is allowed for earning income other source, and it is only allowed up to limited matters. Clubbing of deductions is not allowed under section 56. Under section 57, income from other source is not allowed to club for more than two people, and this two people limit is only in case of related individuals. If in case of minor, section 57 is applied, then the Karta's income will not be clubbed with the minor income, sorry, with the family income, or caretaker income is not affected by the tax liability of minor. It is separately calculated for each individual. So, in case of tax shelters under section 58, the purpose of genuinity and originality will give me benefits. Similarly, there are three special rules. One is insolvency, complete disposal, and material participation test. Now, these special rules are very interesting. Suppose I am a taxpayer and I become insolvent. Now, what is insolvent? My all assets are surrendered to government, declaring that I'm not able to pay a single penny or I'm not able to honor my liability. So, what is the question of tax? If not able to pay my liability, then tax is also my liability. I'm not going to pay the tax. Then, in such case, if the personal insolvency or business declares its insolvency, the rule of section 58 becomes an exception. In some cases, if complete deposition is happens, that is a farm shelter interest, then it is allowed as exemption. The complete depositions means the change of that particular industry or a product or regulations. For example, I'm carrying chemical of H2O. Suddenly it happens in reaction and it way off or it convert into water. The property of chemical will change. So after deposition into particular vessel, if the property or a feature of raw material changes and convert into its final product, then it is recognized as income from business and profession. And then only by deposition if such income is generated, it received as exemption under Section 58. Similarly, material participant test means if by virtue of accident or certain act which is knowingly or unknowingly I involves in a decision where it will be result of deposition or insolvency, then it is again considered as exemption. Section 58 is helpful for my tax planning to understand my tax exemptions and to propose the tax shelters. So we always talks about bond wishing and dividend stripping. I'll just wait 2 minutes. If any doubt, please ask me. Otherwise, I'll just skip and go for next part. So for those who are not understood, the bond wishing, it talks about convertible securities or assets where economic or type of ownership is changing. And bond stripping talks about a situation where the people just purchase the asset with dividend and sell the asset without dividend. So there are two things they are doing. The with are able to get the dividend benefit as additional comfort, and that will be result for their additional price of share. For example, if I have share of X company and company has declared dividends, then since the dividend value is attached to share, the price of share from normal rate it will increase. So that is dividend stripping. Whereas bond washing means if a bond is in nature of convertibility or repayment, then before due date, if somebody buys my bonds just to avoid tax liability, then he will take benefit that if that bonds are converted into shares, he will convert this into shares. So, considering this, bond washing talks about taking benefit of bond, whereas dividend stripping it talks about buying the securities when the dividend is declared and selling them off once dividend is benefited. So these are two parallel terms. In the last, section 94, it talks about transactional securities, fairness, and substances that is purpose or the proof is responsibility of taxpayer. So this is overall summary. So we covered income from business and profession, salary and capital gain. Any doubt in section 56, 57, and 94? Any doubts? If no doubts, then what we'll do is we'll talk now the most important part of income tax, and after that we'll stop for the day. In income tax, we have deductions under section 10, section 24, section 80, section 52. The section 10 is commonly deduction to reduce inflation effects. That is normally 75,000 to 50,000, depend on assessment. Section 24, it talks about deduction from income from house property. And most importantly, Section 80, it talks about deductions from income as salary. So let's talk about Section 80, key deductions as per assessment year 25-26. The deductions which are given in Section 80 are the oldest deduction available in Income Tax Act 1961. These deductions are allowed after calculating your gross income. These deductions are given to motivate people to maximize their savings because if these deductions are not available, then flow of cycle of money will not be controlled easily. It is controlled by banking system by way of CRR or LR ratio or money multiplier, but this is also become an instrument to motivate people for more saving and generating the additional benefit of tax saving. The Section 80 has major role because it is a commonly used as tax evasion or tax planning instrument. The maximum limit allowed for tax saving is 1,50,000 under Section 80C. Then 80D, it is 37,000. 80E, it is 15,000, and so on. So if I find Section 80, it has total 17 subsections having each section a different tax benefit. In 2025, there is major changes about these benefits that income up to 12 lakh it is exempted. So you either go with the old, that is standard deduction, deductions and so on, or directly you take exemption up to 12 lakhs, and after 12 lakhs you are charged for the tax. So Section 18 has importance in old system, but in new system it is only useful if your income bracket is more than 12 lakhs. So as per this rule, we need to find out first gross incomes, and then we'll find out what are the benefits. So the first, no tax on car loans and interest. If the vehicle is used for personal purpose, now the PPT has different deductions. I think the wrong calculations are there. Give me 2 minutes. So I hope screen is visible to you. So when I'm calculating the income, I always find, suppose my total salary received, it is a gross income, and after gross income, I'll deduct HRA, LT, and so on, and then I start for deduction of Section 80C. 80C has various sectional dividends Now let's talk about what are common deductions. I'll share this chart via email to all of you. Just for theoretical purpose, please remember this chart. Otherwise, Section 80 deductions are not so useful under Finance Act 2025. Under Section 80C, investments which are made in LIC, PPF, Sukanya Nidhi, mutual fund, FD, and for children tuition fee, it is allowed up to 1,50,000. Similarly, Section 80C shares its 1,50,000 bracket with investment in pension fund with Section 80CCC and Section CCD. Please remember, when it is said children tuition fee, it is only allowed maximum two children. Similarly, if I'm claiming benefit of mutual fund, it should be tax saving mutual fund. No equity mutual fund is allowed for this benefit. Similarly, the locking period for mutual fund will be 3 years. If I'm claiming under FD, the FD's locking period is minimum 5 years. Under Section 80C, if I claiming investment in LIC, then it should be debt oriented, not income generations. In case of Section 80 triple C or 80CCD, the pension scheme should not be commuted. Commuted means I should not withdraw the pension benefit in lump sum. For example, each month I'm receiving 1,000, but I want money, so I withdraw immediately 12,000 instead of 12 months in 1 month. So the pension which I club together is called commuted pension, and such pension is not allowed deductions. Secondly, under this pension scheme, if the pension schemes are registered under Section 80 or 80 triple C or 80CCD, then only these schemes are allowed as a benefit up to 1,50,000. Then, as per Section 80CCD, additional benefit of 50,000 is allowed for Atal Pension Yojana. Now, this 50,000 will be individual purposes. If it is HUF, the benefit will be up to 1,50,000, but under 80CCB, I will claim for individual additional 50,000. Then under Section 80CCD, it talks about national pension scheme. Now the Atal pension scheme is for salaried as well as business persons, and there is no limit about how much is my total income or gross income. Whereas Section 80CCD, which talks about national pension scheme, here national pension scheme has locking period of 15 years. So amount paid or 14% of basic salary, where salary means basic plus DA, whichever is lower, it is allowed as exemption. So in case of Atal pension scheme, the limit of contribution and limit of salary is there. But in case of national pension scheme, how much pension fund investment I'm making, that is my choice. But as per Income Tax Act, latest provisions, 14% of my basic plus DA or the actual contribution, whichever is lower, is exempted. Then the most important, Section 80D, it talks about medical insurance or preventive health checkups and medical expenses. It can be claimed by individual or it can be claimed by HUF. In both the cases, up to 1 lakh for self and 25,000 for parents below 50 and 25,000, and up to 50,000 if parents are above 60 is allowed as deduction. So for medicals under Section 80D, medical insurance, I can claim up to 25,000 for dependent family, 1 lakh for myself, and for parents above 60, 50,000. This deduction is over and above of Section 80C. So that is 1,50,000, 80CC 50,000, it becomes 2 lakhs. And now under 80D, I can additional claim up to the type of health insurance I'm going with. Under section 80DD, we got medical treatment for dependents. So under normal condition, 40%, or if abnormal condition, that is severe condition, up to 80% of the cost, or 75,000. In case it serves as disability, that is the loss of any particular part of body, and I'm feeling disability, then up to 80% the contribution made for medical treatment is allowed as deduction, subject to limit of 1,25,000. Then under section 80 DDB, medical expenditures which are paid for specific diseases. It can be cancer, it can be corona. The list is mentioned under section 80 DB, and mostly it is for senior citizen only, allowed deduction up to 1 lakh. For other people who are not senior citizens, the limit is 40,000. Under section 80E, interest paid on loan taken for higher education, there is no limit. Whatever the interest you are paying for education loan, you will be allowed deduction up to 8 years. So you can claim deduction 4 years, or you can claim it in parts up to 8 years. There is section 80EE. It talks about deduction on interest paid for housing loan, and limit of interest is 50,000. Whereas under section 80EEA, the same interest can be further deduction up to 1,50,000. Please remember, if you're claiming under section 80EE, you cannot go with the section 80EA. The difference between both is, if interest is paid on housing loan, the location and gender will make a matter. For rural purposes, it is up to 50,000. If it is a metro and the club together, it can be 1,50,000. But I cannot club deduction of section 80EE and 80EA combined together. Then section 80EB, interest paid on electric vehicle loan is allowed up to 1,50,000 as deductions. So if I take a loan to buy an electric vehicle, the interest paid is allowed as deduction. Now, section 80G is the most famous. As per section 80D, if I am receiving HRA, then 5,000 per month, or 25% of income or actual rent paid minus 10% of salary. I consider these three parameters, and whichever lower is allowed as deduction. Section 80GGA, it talks about contribution made for scientific and rural development. As per this, 100% amount up to contribution made in cash or kind allowed, but if it is in hard cash, it is only allowed up to 10,000. Similarly, contribution made to the political parties by companies. Please remember here, individuals are not allowed. Contribution made to the political parties, then for them, the deduction is 100% allowed. Under section 80GGC, if individual makes contribution to the political parties, then no cash contribution is allowed deduction, but non-cash 100% is allowed. So in case of companies, if on deduction it is GGB, but if I want as a person, it is C. Under section 80 RRB, if I pay or received any royalty or patents, the charges or income which is lower than 3 lakh is allowed as exemption. In case of section 80 QB, if I'm an author of any particular script and I receive income less than 3 lakh, I am tax exempted. Then under section 80TT, the interest paid received on saving tax account up to 10,000 it is exempted. Now the interesting story of interest earned is first you have to add this interest in your total income for calculating the total income. For example, my salary income 5,000, but if I received interest of 500 from a bank, then my total income will be 5,000 salary plus interest 5,500. And final, when I calculate the deductible amount, then I'm that time minus this 500 from tax liability. Then interest earned on fixed deposit for individuals who are more than 60 years up to 50,000 allowed as deduction under section 80 TTB. Then under section 80U, the persons with disability, if normal, they allowed deduction of 75,000, and if very serious, then up to 1,25,000. Please remember, in most of the case, these deductions are very important, but you need not require to remember. You just remember section 80C limit is 1,50,000, section 80D medical limit is 25,000 for self and 50,000 for senior citizen, and then interest paid for education loan. So once you start solving numericals under income tax, you will able to realize this. So this is all about deductions, income from other source. Now, next sessions we'll talk about illustrations for income from salary, illustration for income from business and profession, illustration for capital gain calculation, and then we'll do the last part, that is TDS and tax planning. So thank you all of you for being part of this meeting. If any doubt, keep me posting, and you can now go for the next session.